day, the stock market tries to confuse you with fear and excitement. News headlines keep shouting, "Buy now," or "Sell quickly." Most people get carried away by these emotions. They buy when prices are already high and sell when prices are low. By chasing the latest trends, they end up losing money instead of making it. But imagine if there was a clear roadmap, a strategy created nearly a century ago, which still guides one of the world's greatest investors, Warren Buffett, even today. The Intelligent Investor by Benjamin Graham. It won't teach you how to get rich quick. It will teach you how to never lose money permanently and to build sustainable wealth over time. Welcome to Read, Apply, Succeed. The channel, Turning Saucer. Books into life-changing action. Lesson 1. Investor versus speculator. Graham starts with the most critical distinction: investment versus speculation. An investment operation is one which carefully studies an opportunity and it protects your original money while giving you a fair return. If it doesn't meet these conditions, then it's just speculation, a gamble. A smart investor looks at a stock like it's part of a real business. They ask what the business is truly worth by checking its assets, profits, and debts. The focus is on quality and value, not just the stock price. A speculator is basically gambling. They only care about the price, not the real value. They just hope to sell it to someone else at a higher price. This is what happens in day trading, short-term guessing, or buying purely based on hot tips. Graham says, "The intelligent investor is a realist who sells to optimists and buys from pessimists." In simple words, imagine a stock that's worth 100 rupees based on its business fundamentals. During a market panic, pessimists might sell it for 70 rupees. The intelligent investor buys it at 70 rupees, knowing its true value is 100 rupees. During a hype wave, optimists might buy it for 130 rupees. The intelligent investor sells it at 130 rupees, locking in profit. Lesson 2. Meet Mr. Market. Imagine the stock market as your business partner, Mr. Market. Every day he comes with a new price for your shares. But here's the problem. Sometimes he's excited and offers you twice what the company is actually worth. Sometimes he's depressed and offers too low. Graham's advice is simple. The intelligent investor views Mr. Market as a servant, not a guide. Your job is to buy when it's cheap and ignore him when it's crazy. The market is there to serve you, not to instruct you. Lesson 3. The margin of safety. This is the golden rule of investing and Graham's core technique for risk management. Suppose you're an engineer designing a bridge. You calculate the heaviest truck that might cross it, let's say 10 tons. Instead of designing the bridge to hold just 10 tons, you design it to hold 50 tons, 5 times more. Why? Because you're preparing for uncertainty. Maybe a heavier truck comes. Maybe weather weakens the bridge. Or maybe materials aren't perfect. That extra strength is called the margin of safety. Imagine you need 10,000 bricks to build your house. If you buy only 10,000 and some break, the work will be delayed. That's why smart builders order 11,000 or 12,000 bricks. The extra bricks act as a margin of safety. When you buy a stock, you first estimate its true value. Example, you think a company is worth 100 rupees per share. If you buy it exactly at 100 rupees, you have no margin of safety. If you're wrong, you might lose. But if you wait and buy it at 60 rupees, you now have a big cushion. Lesson 4. Defensive versus enterprising investor. Graham breaks investors into 2 types, based on time and effort. First, the defensive investor. This is the investor who wants safety, freedom from bother, and a reasonable average return. Your strategy is passive and minimal effort. The defensive portfolio is a simple split, often 50% high-grade bonds and 50% diversified stocks. such as low-cost index funds tracking the S&P 500. You should rebalance periodically, selling some stocks when they hit 75% of your portfolio and buying back when they fall to 25%. This forces you to buy low and sell high automatically. Second, the enterprising investor. This person is willing to dedicate serious time to research to potentially achieve better than average returns. This requires active selection of individual stocks. Some companies that are genuinely neglected or unpopular, trading at a price well below their intrinsic value. He gave specific criteria, like looking for companies trading for less than their net current asset value, a deep discount strategy that became a cornerstone of value investing. You must decide which one you are. The ultimate lesson of the intelligent investor is that the secret to investment success is not a formula, but a mindset. Control what you can control: your costs, your expectations, and your own behavior. Stop listening to the pundits and the daily price quotes. Treat your stocks as parts of a business you own, not as tickets in a lottery. By mastering your own emotions and committing to a strategy of disciplined value, you can take steady advantage of Mr. Market's follies. You don't need to be a genius to succeed, you just need to be intelligent. If you found value in this deep dive, please like this video, subscribe to the channel for more timeless financial wisdom, and hit the notification bell so you don't miss our next breakdown. Let me know in the comments. Are you a defensive investor or an enterprising investor? We'll see you in the next video.